Welcome back to Talk Tickers. This is the deep dive where we strip away the corporate fluff and get right down to the institutional grade breakdown of the earnings calls that actually matter.
That's the idea. No press releases, just the transcript and the data.
No noise, just the signal.
Yeah.
Today we're turning our attention to the regional banking space, specifically Regions Financial Corporation, ticker RF. And look, I think we have to address the immediate reaction right off the bat.
You have to.
The tape was ugly.
It was tough to watch. I mean, if you looked at the pre-market action, the stock was indicated down over 4%.
Wow.
It clawed back a little bit, sure,
Up to-
but it still closed down 2.63%. And the volume tells a story.
Heavy.
30 million shares traded hands. The average is, what, 13.5 million? So, yeah, people were rushing for the exits.
The market clearly saw something it didn't like. But, and this is the weird part, when you actually listen to the call, management is pitching this really optimistic story. They're talking about headwinds behind us and a major pivot to growth. So help me bridge this gap. Why the disconnect?
It is a classic case of what we call a jam tomorrow quarter.
Jam tomorrow.
Yeah. Management came out and essentially said, the bad stuff is over. 2026 is the inflection point. We're going to start growing. But the market is impatient. You know,
It always is.
investors looked at a messy Q4 earnings miss and a very, very expensive tech bill coming due, and they punished the stock for it. They want the jam today, not tomorrow.
Okay, so let's unpack the jam today part, or the lack of it. Let's run through the headline financials that caused that sell-off.
Let's do it. It was significant. Adjusted earnings per share came in at 57 cents.
And the street was looking for.
61 cents. So that's a roughly 6.6% miss. You miss by that much in this environment with banks under a microscope, you were going to get hit.
And that 57 cents, that's the adjusted number. What about on the revenue side?
Revenue was $1.92 billion, a slight miss against the $1.93 billion consensus, so pretty close.
Yeah.
But it was actually up almost 6% year over year.
So the revenue story wasn't terrible.
No, but here's the context on that EPS miss. It wasn't entirely an operational failure. There was some noise in there.
The one-time items that always seem to happen every quarter.
Exactly. They had about 4 cents of drag from incremental tax expenses and some severance and litigation costs, things that weren't in the adjusted guide. And while the GAAP EPS was 58 cents, the street trades on that adjusted number. So when you miss that by 4 pennies, the algorithms sell first and ask questions later.
So the algos see miss, they hit sell, stock drops. But if you dig into the core banking metrics, it wasn't all bad, was it? I was looking at the net interest margin, the NIM.
The NIM was the silver lining for sure.
Looked like a bright spot.
It rebounded to 3.70%. That's up 11 basis points quarter over quarter. Net interest income came in at $1.28 billion.
It's pretty strong.
It is, but we have to be careful. Some of that bunk was from non-recurring benefits, interest recoveries from loans that paid off. But even if you strip that out, the trajectory of the margin is actually quite healthy compared to its peers.
Okay, so that sets the stage. We've got a noisy miss, the stock gets punished, but the core margin story is decent.
Yeah.
Now, I want to get to that narrative management was selling, this shift from cleanup to growth.
That is the core conflict of this call. Because if you look at 2025, the whole story for Regions was runoff.
Right, they were shrinking.
They spent the year exiting over $2 billion in leveraged lending and other risk portfolios. They were shrinking the balance sheet on purpose to de-risk, just cleaning house.
And on the call, the CEO was very explicit. He said, quote, headwinds are largely behind us. They're basically saying, we're done shrinking, now we're going to start adding weight.
And they have a very specific plan. It's what they call their feet on the street strategy.
Feet on the street.
Yep. This isn't just hoping for loan demand. They are aggressively hiring. They're in the middle of a plan to hire about 120 bankers over 2 years. They landed 50 of them in 2025.
That's a lot of headcount. A lot of other banks are trying to cut costs, so why go so heavy on personnel right now?
Because banking, especially commercial banking, is still a relationship business. You can't just run an algorithm to land mid-market corporate clients. You need bankers shaking hands, playing golf, sitting in boardrooms.
And they're targeting specific areas.
Yeah, they're focusing these hires on 8 priority markets. And the guidance for 2026 reflects this. They're expecting low single-digit loan growth.
Low single digit. That sounds a little modest, doesn't it? Is that really enough to get excited about?
In a vacuum, maybe not. But you have to remember, they were shrinking in 25. So pivoting to actual growth, even small growth, is a pretty significant change in direction. It signals confidence.
It says, we've cleared the deck and now we are ready to sail.
That's the message.
And what are they seeing from their clients? I mean, we keep hearing about recession fears, macro headwinds, but management sounded, I don't know, almost chipper.
I'd say cautiously bullish. They claimed pipelines are strengthening, and they mentioned specifically that corporate clients are starting to spend their excess liquidity on CAPEX and working capital.
So companies are finally opening up the purse strings.
That's the idea. They've been sitting on cash, afraid to spend it, and now they're finally ready to deploy. If that's true, those new 120 bankers are going to have plenty of loans to write.
And there's always a but. Growth costs money. And this brings us to the friction point that I think really spooked the market. The cost of doing business at Regions is going up.
It is.
And it's not just salaries for those bankers, it's the technology bill.
This is the expense elephant in the room. Historically, Regions has spent about 9 to 11% of their revenue on tech.
Okay.
On this call, they guided that up to 10 to 12%. That's a permanent step up.
And this isn't just, buying new laptops or upgrading Windows. They're doing something pretty massive. Right?
Oh, it is massive. They are undergoing a complete core system modernization. For anyone listening who isn't a banking nerd, the core is the brain of the bank.
It's everything.
It handles the deposits, transactions, the ledger, everything. Most regional banks are running on systems from the 80s or 90s. Stuff written in COBOL. Regions is ripping theirs out and replacing it.
Which is basically open heart surgery for a bank.
It is. It's the single most risky and complex project a bank can undertake. They're in user testing now. The pilot starts Q3 this year, and full conversion is targeted for early 2027.
So that's a 15 to 18-month slog.
At least. And during that time, you have duplicate costs. You're paying for the new system while keeping the old one running. It is expensive.
So that explains the expense guidance. They said expenses would rise 1.5 to 3.5%.
Correct. And here's where the skepticism comes in. Management is promising positive operating leverage.
Meaning revenue grows faster than expenses.
Exactly. They're projecting net interest income to grow 2.5 to 4% and fees to grow 3 to 5%. If they hit those revenue targets, the math works. The expense hike pays for itself.
But if the revenue doesn't show up,
then you are just left with higher expenses and a bloated cost structure. And that is why the market sold the stock. They are spending the money now, hiring bankers, paying sauce costs for the new core for revenue that hasn't fully materialized yet. It's a trust me story.
and the market hates trust me stories. Okay, let's pivot to the balance sheet. I want to talk about the plumbing of the bank. How are they protecting that 3.7% margin in this volatile rate environment?
Right. So Regions is doing some interesting engineering here. They announced they add $3.5 billion in forward starting receive fixed swaps.
Okay, hold on. Unpack that for us. What does that actually mean for the bank's bottom line?
Think of it as insurance against falling rates. When the Fed cuts rates, the yield on new loans usually drops, right? That hurts the bank's income. By entering these swaps, they are effectively locking in today's higher rates for future loan production. They're hedging. They're saying, even if rates crash in 2026, we have locked in a floor for a chunk of our portfolio.
Smart. It takes some of the volatility out of the equation.
Exactly. It narrows the range of outcomes. They aren't trying to hit a home run on rates. They are trying to hit singles and doubles consistently.
And what about the other side of the balance sheet? Deposits. We always talk about deposit betas.
This was a win for them. In Q4, the cost of their interest-bearing deposits actually dropped 16 basis points. They're confident in a mid-30s beta in a falling rate cycle.
And for those who don't speak treasurer, a mid-30s beta means what exactly?
It measures how much of the Fed's rate change you pass on to your customers. So a beta of 35% means for every 1% the Fed cuts rates, Regions can lower their deposit payout by about 0.35%.
Got it. So if rates fall, their costs fall too, which protects the profit margin.
Exactly. And that's crucial. They were very specific about the trajectory. They warned Q1 NIM will dip slightly, mostly due to day count and seasonality down to about 3.7%.
A little dip to start the year.
Right. But then they're guiding to the low to mid 370s by the end of 2026. It's a stability play.
Boring is good in banking. Let's talk about the people running this machine. There was a bit of a sentimental moment on the call.
There was. David Turner, the CFO, is retiring. Been there for 20 years. A 20-year CFO is an institution. He's seen it all.
Yeah, there was a lot of that All missed you banter. But from an investor perspective, does a new CFO change anything? New strategy?
Not really. The incoming CFO is Anil Chota. He's been on the leadership team for 5 years. He's a continuity candidate. This isn't an outsider coming in to shake things up. It's a seamless handoff.
Which the market probably likes, especially mid-overhaul.
For sure, you don't want a new CFO coming in and slashing the budget halfway through the project.
Speaking of budgets, let's talk capital allocation. They bought back stock in Q4, right?
They did, $430 million worth. But their philosophy on it was interesting. They essentially said, look, we prefer organic growth.
Right.
If loan demand is weak, like in Q4, we'll buy back stock because we have excess capital. But if loan demand picks up in 2026, buybacks might slow down because we need that capital to fund the loans.
So investors get either growth or buybacks, but probably not max amounts of both at the same time.
Correct. It's a dynamic lever. It shows discipline. They aren't just buying back stock to juice the EPS.
And quickly on credit, any cracks in the loan book?
Just normalization, really. Net charge-offs rose to 59 basis points annualized, but their non-performing loans actually dropped. Their guidance for 26 is 40 to 50 basis points. That tells me they aren't expecting a credit crisis, just a return to normal.
Okay, so to recap, expenses up, tech is expensive, but the margin is stable and credit is manageable.
That's the picture. It's a transition year.
All right, this is the part of the show where we stop being polite analysts and we get a little wild. This is our not financial advice segment. We're looking for the trade that no one is talking about. What do you have for us?
Okay, I'm calling this one the modern core arbitrage.
Sounds fancy. What's the play?
The trade is long Regions Financial, so ticker RF, and short KRE, which is the regional banking ETF.
Long the specific bank, short the whole sector. Why?
Because of that expense elephant we just talked about. Regions is one of the very few regional banks actually biting the bullet to replace their entire legacy core system. They are taking the pain now. That 10 to 12% tech spend is hitting their income statement today, and the market is punishing them for it.
Well, everyone else is just kicking the can down the road.
Exactly. Pure banks are sitting on spaghetti code because they are terrified of the cost and the risk of switching. So here's the thesis. In 18 months, mid-2027, Regions comes out the other side. They will be the only player of their size with the nimble, API-first, real-time core system.
They can launch products faster, integrate AI better.
Run cheaper than their peers. That's the whole point.
No.
So you eat the 4% drop today to own the fintech-enabled incumbent of 2027.
That's the upside.
But here's the kicker, the downside protection. Let's say the 120 bankers strategy fails. Let's say they can't grow revenue.
Okay.
In 2027, they will be a bank with a pristine, brand new technology stack. And you know who loves a clean tech stack?
Acquiring mega banks.
Bingo. If they fail to grow, they become the most attractive acquisition target in the market because a buyer doesn't have to spend 5 years fixing their IT. So heads you win because they out-innovate. Tails you win because they get bought.
That is spicy.
Yeah.
You're basically betting on the IP department to pull this off without crashing the bank.
I am betting that taking the pain early is better than dying a slow death by technical debt. Regions is paying the toll to cross that bridge now while everyone else is stuck in traffic.
I like it. The modern core arbitrage. Again, this is not financial advice.
Please do your own due diligence.
So bringing it all back to reality, what is the final verdict here?
Look, Regions is asking for a trust us year. They want investors to look past the messy Q4 and the high expenses and believe in the 2026 ramp. The market blinked, that's understandable, but the margin trajectory is solid.
And what's the one thing listeners should watch in the next quarter?
Watch the efficiency ratio. Management promised positive operating leverage. If that tech spend doesn't start yielding revenue growth by Q2, if we see expenses up and revenue flat, the narrative breaks.
So keep an eye on that expense line versus the revenue line. If they diverge the wrong way, get out.
Exactly. The execution risk is real, but the strategy is sound.
All right, that's a wrap on Regions Financial. A messy quarter, a big bet on tech, and a promise of growth in 2026. We will be watching. Thanks for listening to this deep dive. We'll see you on the next ticker.